This is the Nightly Business Report, made possible by Digital Equipment Corporation, with its new generation of VAX family computers, connecting headquarters, branch offices, production and research centers into a single integrated computing environment. Digital has it now. By Kidder Peabody, for over 120 years, one of the world's leading investment firms, serving the financial needs of individuals, corporations, and governments. Kidder Peabody, professionalism worldwide. And public television stations across the nation.
Good evening, everyone. Well, the law of gravity hit Wall Street today and financial markets around the world, for that matter, as stock prices plunged even more than they did on Black Tuesday of 1929. When the dust settled, the Dow Jones Industrial Average had lost more than 508 points on volume of 604 million shares. That's nearly double the previous record. We have reports on the impact of the crash from New York, London, Washington, and Chicago.
Suddenly, it was a free fall, a better than 22% tumult in the Dow, and nervous traders were looking over their shoulders, back some 58 years ago this month, remembering a little overacted movie that seemed to hit home today.
Confusion spreads through the canyons of New York City's financial district, and men stare wild-eyed at the spectacle of complete ruin. More than 16.5 million shares change hands in a single day of frenzied selling. The paper fortunes built up over the past few years crumble into nothing before this disaster, which is to touch every man, woman, and child in America.
History does repeat itself to a degree. It might not be as severe as we had in the recession and depression in the 30s when it was more of a worldwide phenomenon. But it could happen again.
Well, there weren't exactly people fleeing themselves off buildings, at least not that we could see today, but there were a near record number of people gathering outside the New York Stock Exchange today to sort of witness history in the making and the opportunity to see incredible drops in the Dow right before their eyes.
I want to see what it looks like when it's in this condition. And then I wanted to see this stock market anyway.
We want to see a piece of the action, I guess, at Wall Street.
What they saw was programmed selling taken to the ultimate art form, as Wall Street's very biggest players stepped in and unloaded multi-billion-dollar blocks of shares, much of it fueled by mutual funds, hard hit by individuals pulling their money out.
And what would normally be a 50-point decline becomes a 100-point decline, and a 75-point decline becomes a 200-point decline.
The panic selling got an unlikely boost from Treasury Secretary James Baker, who tried to stop last week's bloodbath by suggesting over the weekend that the dollar needed to decline more. But that only opened old currency wounds, the same wounds the bond market has been licking for months now.
What has happened in the bond market is now being played out in the stock market, and I think it has more to go.
I think the stock market ignored what was happening in the bond market for a long time until suddenly woke up to it in the last 2 weeks or so.
But for many brokerage houses, the pandemonium was eerily quiet, as traders were reduced to Quotron watching and what little comfort they could get from knowing that in Tokyo and in London as well, the story was the same. Everyone was getting hit. To the end, market analysts are steadfastly refusing to even mention that word crash to describe what's going on right now. Instead, they like to look at it as a correction that still has to work itself out. But what they don't know, and in fact readily worry about, is how far down that correction really has to go, how long it will take, and exactly how many more people will be hurt in the process before the market does decide, if it decides, to turn around. In New York, Neil Cavuto for the Nightly Business Report.
This is Shelley Carabell in London, where the reaction was especially bad because the exchange here was closed Friday due to storm-related power cuts. The FT100 index lost more than 150 points in the first 2.5 hours of trading, then plunged to 302.1 points down when Wall Street opened. London stayed open an extra hour in an attempt to recover, but when the closing bell sounded, the index stood at 205.2.3, down a whopping 249.6 points. In Paris, the Bourse indicator fell by 10.36%. Food companies which export to North America were especially hard hit. In Frankfurt, West German stock prices posted their largest losses ever. The Commerzbank index tumbled a record 132.5 points to close at 1876.6. Earlier in the day, Tokyo's Nikkei average lost 620 yen in its sixth largest fall on record. Dealers blame the worldwide decline on the sharp drop in the dollar and fears of higher interest rates. All the money that drained from stock markets went into gold, which closed in London at a 6-month high of $485 an ounce, up $19. In London, I'm Shelley Carabell for the Nightly Business Report.
This is Scott Gervey in Chicago, where today traders were using words previously forbidden. Panic, crash, free fall, meltdown. They just put their hands in their pockets and stared in disbelief as the Standard & Poor's 500 future fell and fell and fell.
People are very afraid that when they have profits or they start seeing losses, and they all want to do the same thing at the same time. So moves that take months can end in weeks. It's just this very quickness of this is just stunning. That's the main thing that's different about this move. I would have assumed that it would have taken a few weeks. It's only taken a few days.
Whether index futures and options traded in Chicago through program trades and portfolio insurance strategies actually caused the traumatic decline or just increased its magnitude is a question the academics will ponder in the months ahead. Today, for the traders, the only thing that mattered was survival. Those that did not will be putting their seats up for sale in the days ahead. Those that did are looking for a bounce back.
We will see a calming effect in the next day or so. We will see the market stabilize, and then we will see a reevaluation of all the information that's caused this break to occur. And I think the market will stabilize and start back up to some degree. I don't think this is the beginning of another huge leg on the downside.
These traders will be back here at midnight in a special emergency clearing session to clean up the paperwork that accumulated during today's frantic trading. In Chicago, Scott Gervey for the Nightly Business Report.
This is Bob Friedman in Washington. Federal Reserve Board Vice Chairman Manuel Johnson tried to calm the financial markets today. In a midday speech before an American Stock Exchange conference, Johnson predicted a healthy U.S. economic expansion with little inflation, and he tried to head off Wall Street fears of a plunge in the dollar.
What we don't need at this point, after we've had a 40 to 50% adjustment in the exchange rate against the other major industrial countries' currencies, is to try and depress the dollar dramatically from this level on.
Early this morning, as analysts here nervously watched the Dow plunge 200 points, SEC Chairman David Reuter raised the possibility of a halt in market trading.
I'm not afraid to say that there is some point, and I don't know what that point is, that I would be quite anxious to talk to the New York Stock Exchange about a temporary and very temporary halt in trading.
Reuter did talk with New York Stock Exchange officials early this morning, and the feeling was that the market's dip was caused by weak economic fundamentals. And while exchange officials are worried about market volatility, the American Stock Exchange's Arthur Levitt opposes a temporary market halt.
I think the effect of any artificial interference in our markets is to suggest that the markets are not broad and liquid enough to handle any kind of economic phenomena. And that, I think, is a dangerous message to send about markets which historically have been as resilient as ours have been.
Reuter says that the SEC is concerned about stock market volatility, but wants to wait until after this current surge to examine the problem further. But now, after the worst day in stock market history and volume that went beyond some exchanges' capacity, the SEC and the exchanges may be under pressure tomorrow to intervene if the Wall Street rout continues. In Washington, Bob Friedman for the Nightly Business Report.
New York Stock Exchange Chairman John Phelan declined to characterize today's market action as a crash, saying what happened was a significant correction after a 5-year run-up. And he said the exchange will open as usual tomorrow morning. But first, for the specifics of what happened to stocks today, here's Paul.
As panic selling erupted on those foreign stock exchanges, as you just heard, prices on the New York Exchange continued to plunge early today in an extension of last Friday's record one-day loss of 108 1/3 points on the Dow Industrial Average, down to the 2246 level. The opening sell-off was massive as the Dow plummeted 201 points by 11 a.m., with 1,600 stocks down and a mere 70, mostly precious metals issues, moving higher, while the tape was running over an hour late. What was the cause of this wholesale liquidation? Our frequent market monitor guest Jim Stack, editor of the Investec Letter, who was worried about the bull market on his last visit with us on June 5th, told me one of the major factors, if not the major factor, was forced mutual fund redemptions. Add to that the downside pressures exerted by snowballing portfolio insurance and futures-related selling, and the industrial average tumbled to a 271.5-point loss by 2 p.m., with only 50 stocks up, 1,850 down. With not even a hint of any meaningful technical rebound, stocks continued to plunge on record volume throughout the afternoon, with the Dow off 296 points at the 1950 level at 3 p.m. The final hour saw the bottom drop out as more margin call and mutual fund liquidations, combined with all those wonderfully innovative computer-driven strategies, well, they pummeled the Dow Industrial Average down to a record loss of 508.32, putting it at 1,738.74, which is also by far a record percentage loss of 22.5%. No available high or lows. They're still figuring out. The tape was 2 hours and 10 minutes late at the final bell. Trading volume, obviously a huge record, 604.4 million, and 1.1 million shares of up volume, nearly 603 million shares of down volume. The Dow Transport's tumbling a record 164 3/4 points. Utilities down a record 29.16. Dow 65 a record loss of 168.5 points. And the closing tick showed no mercy, still a very negative minus 933. Standard & Poor's 500, these are all record drops, 57.87, 67-point loss in the 400, the 100 off over 58 points. SPOC 250 down 30 1/3. New York Stock Exchange Index itself down 30 1/2 points. NASDAQ tumbled 46.12. Value Line off 30 2/3 points. And the Wilshire 5000 a record loss of 503 1/fraction.